Yo, what's up, winners? Thank you for tuning in.
Hey,
Yo, what's up, Joel?
good morning.
Good morning. So is it Farrell or is it Pharrell? I usually add accents on stuff because it's
Yeah, not to call out our friend Mark, but it's Farrell.
Farrell. That's what I thought it was. I was like, it's my Hispanic background going Pharrell. Just adding accents here and there. How you
Yeah,
doing, my man?
yeah, doing good. Yeah, Mark, uh, definitely goes Pharrell, and I don't even know where that comes from because you have Will Ferrell and Colin Farrell, some actors that are out there, and it's definitely Farrell. It's very Irish. So, uh,
Farrell. All right. Wasn't there a rapper named Pharrell?
yep, yep, is a rapper. He's out
With
there.
yeah, with the PH. I remember back in high school, PH was like the cool way to spell fat
That's
and stuff
yep,
like that.
yep.
So I saw you had a live stream this morning. That was going very well. I got a chance to tune in.
Yeah,
I
thanks
think it's
for
good
checking that
content.
out. Yeah, I had a lot of fun on that one. Um, we're just in weird times, right? And like
Yeah,
to be able to get people that are generating income streams, that are doing things, learning new things, and sharing things. It's just a lot of fun to be able to get people together, share ideas, and share insights on things, and hopefully be able to inspire somebody else to be able to knock down their own dreams and goals. So um, it's just a lot of fun.
you know what? Not only is it fun, I think it's very important actually. Um, to get ahead now, you need multiple streams of income. That's just the way things are now. Things are getting so expensive, and I don't see any type of slowdown at least in the near future. So I do believe things are going to get worse as far as prices goes. You know, when gas goes up, energy goes up, everything else goes up just simply because of the transportation.
I mean,
So
it's scary.
yeah, it really is. Um, so Joel, thank you for meeting here with me. You have a ton of knowledge, background, and experience when it comes to getting people pre-approved and qualified for a mortgage, whether it's their first home or maybe even their 10th home. So before we jump into those questions, tell us a little bit about your background experience. How long you've been in the game? How did you get started? And do you have your own firm now, or are you working with someone else?
Yeah, so I started in the mortgage industry in 2006 when I got out of college. I was working at a restaurant, um, serving tables, and I had a regular that would come in for their kids' report cards, and she, requested sitting in my section or whatnot. It was at the Melting Pot, and after about a year of her coming in every quarter, she's like, Joel, I like you. I'm gonna get you a job. I'm like, okay, cool. What is it? She's like, it's a Citigroup. Okay, that's cool. I had a good
Yeah.
degree, whatever. Got into the mortgage industry knowing nothing, and um, you know, had a good training program. And I was working with financial advisors and their clients. So I was 23, working with high net worth clients and not know anything, but learned it fast. And what's so unique about that journey for me personally is you're in the game talking to people about money, pretty much over your head kind of stuff. But you learn fast and you see what people are doing, and you see the good, the bad, the ugly, and everything in between. And you see what people are doing, and you also learn what not to do. And I bought my first house in 2009 with they had a big tax credit back in that time frame, and it was a condo. And
Was
I
that the
was
$8,000 one?
yeah, it was. So the
Uh,
one in '08 was a loan. The one in '09 was the forgivable grant, and I
ah,
was scared
that's the one I
shitless
missed.
because the price was like 230. Working in a sales commission job, like you don't know how you're going to get your paycheck in 4, 5, 6 months.
230,000 was your first condo?
Yep,
Wow, congrats.
that was a lot of money back then. You know,
Yeah, this was 2009, you said?
yeah. So I kind of took a leap of faith and did it, and I was very intentional of where I purchased it. So for those of you that don't know St. Louis, first off, I'm a massive St. Louis Rams fan. So that's a different story. But um, there's a town called Brentwood, like right in the middle of the county, and it's where several intersections cross, and very high traffic. There's a big Target right there. So I bought in that area. It's actually a new construction condo. So I knew that if something happened to me and my job or income, that I would be able to rent it out in a heartbeat. And that was part of risk minimization at that point. And there wasn't really a lot of people talking about rentals in that time frame on
Yeah.
social media or whatnot. I read the Rich Dad Poor Dad stuff back in the day, but there wasn't the amount of community and resources out there about real estate investing. And for me, I just kind of built a portfolio on accident. And it's just weird to say, if I'd have known what I known today, I would have done a lot more. But I bought
Oh,
my
yeah.
second property in 2013, and then turned that condo into a full-time rental, and then bought more in 17, 18, and then continued to go. And just, I call it the stair step method: buy a property, live in it for a few years, save up, buy the next one at a slight upgrade, do a primary residence loan, say 5% down, turn the old one into a rental. If you can do that a few times, you're going to be setting yourself up to be able to have assets growing with you for the long term. And there's a lot that goes into these little details of how to do it, what to do, and strategy. But like, if you can acquire 4 properties in your lifetime, that's massive. That's well above the majority of people. And I've got a friend of mine been on my podcast. His name is DeMarco Anderson, and he's a prime example of this strategy. And I met him halfway through his journey,
Yeah.
and he was in North Carolina, an IT guy making good money. He had 2 full-time jobs, working 2 full-time jobs, stockpiling cash, and he bought basically 5 properties in 5 years.
Wow.
And the last half of that was in Houston, Texas.
And
And
how old is he?
he's in his, I think, mid 30s by now.
Wow. So let me pause you right there. That's a lot of great information. So let's go back to the beginning. So it's 2006 and you're waiting tables, you said?
Yep.
Okay. So in 2006, if I recall correctly, I was a loan officer assistant. And I was not a loan officer, unfortunately, because I was not 18 yet. So I legally couldn't work full time and sign documents.
Right.
So I was a loan officer assistant. So what I would do is I would verify the pre-qualification loans and as a broker and be like, okay, this person will probably get approved at this lender based on their credit, their loan to value, etc. So I was seeing all these people make all this money uh, because back then there were loans that didn't require income verification, job verification. So we'll touch on that as well. So I'm glad you're in that era where you can speak of. So by the time I turned 18, all that money making opportunity was gone. And then, you have the 2008 crash and all this new regulation where now it's uh, a different process to get approved. So you started in 2006 as a loan officer. They trained you.
Yep.
And then 3 years later in 2009, you buy your first property for 230,000.
Yep.
Okay. Well, congratulations on that. It's a great move. I do like when you fast forward now, the stair step method. Now, I haven't read, when I go on podcasts, people usually go, you go, what book changed your life or what book do you recommend? And I'll be honest with anyone listening, I'm not a book reader. I read a lot of articles, I read a lot of information, a lot of newspapers, but as far as books go from beginning to end, like there's so very few, and most of them are just because they were school assignments. But based on my own knowledge and expertise in the real estate industry, I would say 4 is the magic number to set yourself up for retirement comfortably and leave some shade for your next generation. And maybe we can talk about this in a little bit down the line. But to me, it's like you can rent out one property long term, there's income. Rent out one short term, there's income. Um, you could be living in one and now you're eligible for a reverse mortgage. So now
Mm-hmm.
it's paying you instead of you paying it. So a lot of people like to argue on X, oh, dividend investing is the best, Bitcoin is investing is the best. And what we can slam dunk say with real estate is true, tried, and 100% always worked. Now, the thing with me is like, why are you guys fighting? Why can't you have all of it? I mean, I also hold Bitcoin. Like, you know what I mean? So the big thing is like, oh, Bitcoin is a bigger asset, this and that. So now with real estate, right? If I want to cash out $60,000, um, someone like you will help me out, get the loan process, cash out 60. And the beautiful thing is I still hold the asset.
Mm-hmm.
Versus with Bitcoin, if I want to cash out 60,000, I have to really ask myself, do I want to get rid of that one Bitcoin? Now, with other cryptocurrencies and other blockchain technologies, you do have the technology in place to borrow against it. because
Mhm.
that's how early we are to the game. The way I see Web3 right now is we're as early now as Starbucks, Amazon, Apple, all in 1991. Like that's how early we are. So the opportunity is is tremendous. Um, so walk me through your loan officer job. Were you seeing people get approved easily? Were there anything that you saw that would be considered a red flag now? Um, and then from there, let's move on to what you're seeing today. So what were you seeing back then in 2006 versus what you're seeing now? But let's start with the 2006 portion.
Yeah. First off, mortgage rates were in the sevens.
Yes.
Prime was at, I believe, eight and a quarter at the time. So
Yeah.
that's just all I knew. And
I remember we got a 6.9 that was good. Good
yeah,
point nine.
yeah, we did a lot of home equity loans, and we use the term AVM, so automated valuation. I don't even know what the M stands for, but we would do a lot of home equity loans, and we could close these in 12 days, where you just get an automated verification on income and valuation, and I'm sorry, stated income, pull credit, automated valuation on the appraisal, and there wasn't a whole lot of extra red tape. On the
Wow.
mortgage side of things, the terms NINA, no income, no asset,
Okay.
stated income.
So just to clarify for the viewers, the first part you were mentioning is everyone that already has a mortgage and wants to refinance their loan. Now you're going to the part where it's a new mortgage loan.
That's right. Sorry. Yeah, that's right. So yeah, someone trying to purchase a home, you could do these with no income, no assets. And that's part of the reason why we had the housing market crumble. Um,
Hmm.
but I worked at a big company called Citibank. And so the things that we were doing were pretty much insulated from what the street was doing. So we had
Yeah.
all these regulations and things and processes that we had to do. And then what's interesting is that when you talk about the brokers, which means that they're on the street, they go get loans and then they send them to a company like Citibank to underwrite them as a third party. Whereas
Yes.
I work at Citibank, all our underwriting is in the same building, essentially. Um, the stuff that they were bringing from the street into Citibank, they were underwriting them on different guidelines. And so I use the word shit. They were shit loans because, they weren't verifying anything. And so it's just interesting looking back on it. You're in the kind of in the eye of the storm. And
Yeah. So let me pause you right there. So
yeah,
that does ring a bell, right? Someone could be interested in buying a home. They can go directly to the lender, in this case, Citibank,
uh-huh,
or they can go with the broker that would shop around, and one of those will be the middleman to Citibank.
yep,
So Citibank directly has certain eligibility requirements to follow.
mm-hmm,
But if they go through the broker route, a lot of times there's discounted mortgage rates and more lenient, more bending the rules on the requirements. That's how I recall it. Is that what you're
that's what I'm saying.
clarifying right now?
That's exactly what I'm saying. Yep.
So when your phone rang or when you got an email, your preference was directly to Citibank or from a broker? Who did you want to hear from the most? Or
So my role, I was working in a channel that all I did was service financial advisors with Smith Barney. So I was taking care of their clients. So the calls and emails would be coming from that network of clientele. And then there were other departments that were direct to consumer, which is people that had Citibank accounts or already a Citibank mortgage.
yeah,
They would just call in the number and go to a general line and a round robin. And then there were other channels. I think there was like corporate relocation channel as well. So they're different channels, but yeah, I mean, you're in inside sales. You're a call center. It's all inbound.
yeah. Okay, I do remember that the being the inbound, and I always got preference because I spoke Spanish. But the market share wasn't that big back then.
Yeah.
So thank you for sharing that. So now we've gone over a little bit about your background, when you got started, when you got your first property, the things you were seeing back in the day, which, yeah, some of those loans, I don't want to say the word because I'm monetized on YouTube, so I don't know, but SH ends in T were that. And for anyone that's tuned in, if you want more information on that, the movie I recommend is The Big Short.
Yep.
So a bunch of these loans, um, well, let me take a little bit to the side, right? When a lot of people say, oh, there's going to be another real estate crash, right? So out of the last six recessions, real estate has only crashed once. Um, and that one time it crashed was in 2008. And the difference between that recession and other recessions was that this one was actually manually pumped up and created. Like
Hmm.
people were feeding the bubble, which is those mortgage loans where they were coming in with no income verification, no asset verification. So today, because of what took place, now we have a new, or what I would say, a 2.0 version of qualification for a mortgage. So I mentioned this on X, where the borrower today is a more qualified borrower than what they were at this point, what, 15 years ago now, 20 years ago now?
Hmm.
Which means you have a person that's technically on paper more responsible who would rather fall behind on their car payment and their credit card payments than their house payment. And they're not in a place that they were in 2006 or leading up to 2008 where they bit more than they could chew, so to speak. So today, I have a lot of people reach out to me. They want to get their first home. A lot of my audience is Gen Z and millennials. So first question is, I see Gen Z hopping around jobs more often than other generations. To my knowledge, it has always been that you need at least 2 years of employment, not necessarily in the same job, but the same field.
Hmm.
So if someone wants to go to get their first home today, what is that job requirement? So let's clarify that. And does it vary by state?
From the state part of it, the guidelines are pretty standard across state lines.
Okay.
So, you know, each state is going to be pretty similar in terms of how they look at the actual requirements. But
Yeah.
if you've got a 2-year work history, and let's say you've got a job that you're working as an admin at a company, and then you get laid off from that job, and you're making 15 bucks an hour.
Yeah.
And let's say you've got a 30-day gap of employment, and now all of a sudden you get a better job making 25 bucks an hour.
Yeah.
That may be a different field, but let's say you've been at that current job for say 12 months, over 12 months. That would be an example of, okay, they've reestablished consistency in their new job. They've got a 2-year work history. The gap of employment is only 30 days. So we just want to be able to document it and explain it. And if it makes sense from an underwriting standpoint, that they believe that it's consistent and stable, then we should be able to use the income. Now, again, then you start talking about the different loan programs, a conventional loan, say through Fannie and Freddie backed,
Mhm.
versus FHA, which is a different backed with government securities. They're going to
Okay.
have different stances on some of these guidelines like work history or gaps of employment and things like that.
Yeah.
You start talking about overtime and commissions and bonuses, and these things can come into play, whether you have variable income. Um, Even if you've got a gap more than 30 days, let's say you've got a gap of say 6 months, um, and let's say it was very, very recent in the past 12 months, that's going to be a bigger hurdle to overcome to be able to document stability of income at that point. If that 6-month gap was 18 months ago, um, the further away it is, um, and the more you've reestablished stability of income, the better your chances of being able to fit it into the guidelines.
Okay. So what I'm hearing, and correct me if I'm wrong, is a 30-day gap isn't necessarily a red flag. They would be underwriting, manually reviewing this, taking a look. Okay, that makes sense. Maybe they were laid off or they were switching and had a different start date right after a 2-week notice, something like that. Versus 6 months, it's like, okay, what happened here?
Mm-hmm.
Is that what I'm understanding?
Yep.
Okay, so let me explain this scenario to you. So I'm in California. We know it's really, really expensive. So a lot of people are looking to buy property outside of state. Now, the second hardest thing to do is save up for a down payment. So let's say 25K is not enough for 5% on the starter home uh, in California, but 25 might be 10%, for example, in Nevada, like a starter condo. So now things are looking good from a lending perspective.
Mm-hmm.
So they have one job in California. Is an offer letter enough to qualify for a mortgage on that new state as a primary residence? So we've seen the huge fluctuation from people in California moving to Nevada, people in New York moving down to Florida, and everyone else in the middle moving to Texas.
Yeah.
In the trend. So, for example, I have a job where I could work from home anywhere, right? So there wouldn't be much of a change. But for those people that are thinking of moving to different states, is a job offer letter enough to be like, okay, you're still employed that 2 year period, etc.
Yes. So for VA loans, conventional loans, and FHA loans, we can use an offer letter with a start date that's actually past a proposed home closing date. Each of those is going to have kind of a different time frame between 30 days and 60 days.
Mm-hmm.
So the key though is that that offer letter has to be cleared through where there's no contingencies left. Meaning, sometimes you'll have an offer letter says, you're going to start on June 1st, pending criminal background and other things.
Yeah.
Well, we want to be able to see that, hey, this is your start date, and there's no other contingencies on that letter, and that would be acceptable. So yeah, you can use those for sure.
Awesome. That's really good to know. And again, that whatever the dollar amount is uh, goes into play, whatever that state is, etc. Now, I've heard from Instagram, and correct me if this is accurate or not. A lot of times, if you're a student and then you start working, so let's say you're a student and you have one of those degrees where you have a job guaranteed once you graduate because of an internship or something, such as an engineer or someone in IT, usually, right?
Mm-hmm.
So if they're a student, say if they graduate next month and they have a start date and offer letter, they're going to start after graduation in June or July and make $200K a year.
Mm-hmm.
Is that acceptable? Is schooling acceptable in that sense for that 2 year requirement?
Schooling is definitely acceptable in that scenario. I have to double check guidelines to see if there would be a minimum requirement for amount of time at the new job.
Yeah.
So again, this is just pure speculation because I don't have the guidelines in front of me. But let's say that you had a job offer letter and it was on June 1st and you wanted to buy a house tomorrow. It probably wouldn't work. I mean, again, I could be wrong. But if you've been at the job
that would make sense though.
3-6 months, there's a chance. If you've been at the job for 12 months, you're probably in good shape as long as it's
probably solid.
Yep.
Okay. Now, because I remember,
I love this question first off because you start talking about finding opportunity and hacking the system, hacking the guidelines, and finding the loopholes that are legal and usable. This is the stuff that is a major opportunity. So I love this stuff.
Yeah. So I wanted to not only just ask the questions on how to qualify for a mortgage, but those tips and tricks that people may not be considering. I know a lot of Gen Z shoots themselves in the foot to buying a home because they do switch jobs that often. So I wanted to clarify the industry, the umbrella, the time at the new place, etc. And then you have the other people who've been thinking about it while in school, and if that counts for something. So now we have scenarios where they're transitioning to the workforce or transitioning to a different state. So thank you for that information. Now, both of these, I'm guessing, aren't state specific. They're program specific, whether it's FHA or whether it's conventional, is my understanding now, correct?
Yep.
Okay. Now, aside from those two scenarios, what is the challenge that you're finding that most people are having in today's market to qualify for a mortgage loan? We know we have record credit card debt for the U.S. consumer. We have record inflation in its lifetime, at least the first I've seen, right? I wasn't there in the 70s. And the dollar's losing its power by the day, right? So a lot of savings are being eaten up right now. But what are you seeing when people come to you that the boxes aren't being checked anymore, that they need to work on and get this approval?
Yeah, there's a couple levels. I think the biggest thing that I would say first off, because there's a lot of people who are struggling to be able to qualify. And the biggest limiting factor that I've seen throughout my entire career for people who want to purchase a home is just having the money saved for down payment and closing. A lot of conversation about down payment programs and this and that, which there's always restrictions for those. So that's a big part of the puzzle. But there's still a lot of people who can qualify. They just are not wanting to or don't want to make that decision or pull the trigger. And I think it's a confidence thing. The biggest question that I get right now is, hey, well, what do you think the market's going to do?
Yeah.
I keep hearing there's going to be a crash. I don't want to put $20,000 that I've worked for 5 years to save buy a house and maybe have a little bit left over, and then my house value is going to go down.
Yeah.
That fear is understandable. I was in the same place. I think that's the biggest concern, biggest question, and there's no right or wrong answer to it. But that piece of the puzzle is tough. But having the money saved, that's the biggest thing. I use the word trajectory a lot. You know, when someone purchases an asset, I'm gonna take 10 grand. I'm gonna buy Apple stock. I'm gonna buy a house. I'm gonna buy Bitcoin. You have to have a level of confidence and everything else in your life to be able to say, I'm gonna use this money, put it in something else, and not touch it for a long period of time, because there's always cost to be able to liquidate something.
Yes.
So confidence in everything else that's going on is so important and not talked about enough to make these decisions. So that means inherently, when we talk about savings, the equation is very simple. It's income minus savings equals your income minus your expenses equals your savings. All kinds of content out there about budgeting and cutting your expenses, and that's important, but it's also not the entire part of the equation. And that's why on the Strive for 25 channel, if you look at any a lot of into the content, a lot of it's on income. I mean, not enough people are talking about how to increase income, and if you can increase income or add an extra income stream, for me personally, and for the people that I work with that are going down this stair-step method, that confidence, hey, I can push the pedal on this avenue to make extra income. I can control this thing over here, and that's giving me more confidence to take a little bit of risk to say put my money into an asset, and whatever, it doesn't matter what the asset is. And the word trajectory, if you've got somebody that's set in their ways and they're on a flat trajectory of income and growth, there's less margin for error if things don't go perfectly with whatever type of investment it may be. If someone's on an upward trajectory, like your YouTube channel, where you just crossed in a monetization, and imagine where your channel is going to be in 2 years or 5 years, the level of income and growth and brand and other opportunities is going to be exponential. You're going to have more margin for error for every decision you make. And I think that's the part that, as I look back on things, is, because when I bought my first house, I was working 60 hours a week. Like, rates had just come down in 09 to like 5.25. Like, we were just going crazy working 60. Like, we would go work.
Yeah, 5 was a bargain.
Yeah.
Back then.
Go work, grab dinner, maybe even grab a drink at the bar across the street, go through the football in the parking lot, and then go back to work at like 8 o'clock until like 10 or whatever. That's how busy we were. But that's the stuff, unfortunately, where we are. I mean, the old formula just doesn't work.
Yeah, I'm glad you bring that up, because now with the internet, so, well, two things, right? First, let's talk about the fear that people have.
Mm-hmm.
So when people say, you go, why do you win so much? I got over that fear. I was the first one to take that step. I was the first one to jump in the pool. I was the first one to jump off a cliff, metaphorically speaking.
Thank you for
And
that.
that's what makes or break the difference between what is now the haves and have-nots. So back in the day, people would be like, oh, how much are you paying, this and that, and they would compare what it would be equivalent if they were going to go rent their own apartment. Now at the time, yeah, my mortgage payment was about $300-400 higher than what the equivalent would be on the rental market. But after 3 years, they're paying more than what I was paying because my mortgage was locked in.
Mm-hmm.
And after those 3 years, I'm getting promotions and I'm widening that gap between my income and my debt. So for anyone listening, and you have that fear, again, of the last 6 recessions, housing prices have only crashed once, and all the reasons why the housing market crashed are no longer valid reasons anymore. There's no such thing as those type of loans, and the subprime market doesn't exist anymore. So the chances, if the question is, what is the market going to do? To me, and I mentioned this with the uneducated economist, and there was an article today from Bigger Pockets, right? The border is wide open. And we were already 6 million homes short before the border was wide open. And I think there's an estimated 4 million more people now, right?
Wow. Yeah.
So you're already 6 million homes short at the start of 2020 or 2021 or whatever. And now you have 4 million more people. And we haven't built 10 million more houses, 9 million more houses, 12 million more houses, right? So the demand is only going up and the supply is going down. And I see a lot of politicians mention, we're going to help a lot of first-time homeowners, right? but there's no solution to, which is only pumping up demand, right? Because it's sweet
Mm-hmm.
talking. Like, oh, that sounds nice. I want them to help me out on my first
Mm-hmm.
mortgage, right? But all that does is pump up demand. It doesn't do anything with the supply. I mean, there's two sides of the equation. So houses, at least in my eyes, are only going to keep going up. And I recently made a video where I think time is running out because as rates stay high and prices keep going up, the opportunity to qualify for one I see is diminishing, at least for the younger generation. We could practically see Gen Z as probably the lowest generation ever to be homeowners before the age of 35. So, for anyone listening, you're probably closer than you think, right? And I don't think there's going to be a housing crash like that in 2008. And if you think about it, in 2008, it probably crashed around 30% nationwide. Obviously, there's different regions that crash more, but overall, it's 30%. If there's a 30% crash now, you're only talking about 2022 prices.
Right.
And
Right.
2020, right? So if you really think about 2022 prices where rates are over 5% at this point, like if you weren't eligible for a mortgage then, that fear shouldn't stop you now. Because again, now you're going to get 2022 prices, but with 7%, 8%. So for anyone listening, please take that first step. That's what's going to separate, the way Biggie says, the weak from the obsolete in one of his rap songs. Um, Now you mentioned the saving for the money. So let's talk about that. My understanding is you have to have the money saved up 60 days in your bank account. Is that still a thing? What about if someone gifts you the down payment?
Mm-hmm.
Uh, and then some of these programs that that people may not know they're available, um, for first time buyers. Maybe more local programs, or what can you speak on that?
Yeah. So I'll give you an example. There's a program called the Maryland Mortgage Program. That's for people that need help with a down payment. There's some limits to it. There's income restrictions you have to fall under.
What is it called?
It's called the Maryland Mortgage Program,
Maryland Mortgage Program.
MMP for short.
All right, let's see here.
And they have
Hopefully I
set
spelled that right.
interest rates.
Yeah.
Maryland. Sorry.
Oh, Maryland.
Yeah. But they have set interest rates for the program, which typically are higher than the market. And it's just one example of a program. And I'm not trying to, pick any battles with anybody, but there are limits to it because, okay, you're getting help with say 4% or 5% of the down payment, but you're also paying for it in your rate for the long term.
Okay.
There's another restriction that comes up too. It's, I get the loan approved, I have to ship it off and get it approved by the third party. So that can be a hurdle in the back end for closing on time. And so if I'm a listing agent and I've got 3 offers and one of them has a down payment assistance program, the other ones are good enough offers, there's a chance that your offer may be at the bottom. So it's something to be aware of in a competitive market. And every state has their own different programs, Virginia, Missouri. Missouri's is called MHDC. And there's some pretty powerful programs there where the rates are actually lower than the market if you're not using the actual down payment assistance part. So
Yeah.
It's important to really kind of talk to a couple of different professionals and 2 or 3 people in the industry, because they're going to have different expertises, different types of knowledge and experience, and maybe good at one thing and not good at the other thing. So it's good to be able to have multiple conversations. To your point about the deposits and bank statements, the biggest thing is that the IRS they want to know where money's coming from. They don't want to do money laundering.
Oh man, my favorite people.
You're right. So if underwriting sees a deposit going to your account that's considered a large deposit, let's just say it's $5,000 and it's higher than what your typical income monthly installment for income would be, they would want to be able to document where the money came from. And so let's say it came from another account of yours that you just deposited over. Cool. We'll just document it with the other account statement to be able to show the transfers. If it's cash, we can't use that for closing. If it's a check from your grandma, that's where the gift part would come into play. And that's acceptable.
Okay.
We document.
And will there be requirements for the grandma to show statements, or is the letter sufficient?
We have to show a statement showing where the money came from, that she's able and has the money in her account, and then a gift letter that we would provide as a lender to them to be able to execute.
Okay. Now, what about if the grandma is a homeowner and the money's going to come from a home equity? Would you say wait to withdraw, or would you say withdraw now, wait the 60 days, and then?
So if we can document it, we can use it.
Oh, I see. As long as you're able to document.
Uh-huh.
Okay. So
Now,
whether it's liquid in the bank account or um, frozen in a home equity that can easily be liquidated,
yeah.
as long as
But
it's tracked.
but the 60-day part is important. I mean, because from a guideline standpoint, more times than not, there's obviously exceptions to the rule depending on the person's income profile and everything else. We're going to want to see 2 months bank statements. And if there's no deposits in the last 2 months and the money's just sitting there, that's going to be less opportunity for underwriting to ask questions.
Now, let me ask you this, and again, this is for a lot of newbies here to get creative and more tips and tricks. Is it possible? I mean, I've seen this, but it might vary by state, or maybe it was just a different time. The money was only in there in 30 days, but that one document for the next 30 days would be available by the time it's ready to close. So are you able to approve someone and say, oh, it's only been there for 30 days, but by the time we get XYZ and the appraisal back and everything, now that second statement becomes available? Is that
Mhm.
possible, or would someone still need to wait that 60-day period?
I love the question. I'd say it's possible, but at the same time, it's still a human business, human people looking at guidelines. So underwriting still has the ability to ask the question, and then maybe it becomes a
Okay.
battle.
So we just have to make sure underwriting's happy and that maybe it's a Friday afternoon.
Yeah, because it's like, okay, let's say I get a contract today and it's going to close on June 5th. It's less than 30 days. And let's say that second billing cycle comes out, 4 days before closing. It's going to be a tight squeeze to get everything into underwriting, get everything cleared and all that stuff. But if it's a 45 to 60-day close and, underwriting looks at the file and they say, okay, I see the money in here, and, they're going to condition the file for more things. Okay, well, we're still waiting on the appraisal and title work and insurance. And, oh, by the way, we only have one bank statement. Give me 2. And then we just wait to give it to them later in the process.
Yeah.
I've seen that work.
Okay. Cool. Yeah, I wanted to make this video where just tips and tricks that people can consider to make this process a lot easier for them and not so like black and white. It kind of touch over those gray areas where this could be done. But again, this is all going through a broker first and not directly the lender. Or would you also be?
So I'm just talking about this. Okay, so I'm a mortgage originator. I work for a company.
Yeah.
So not a broker, but
Okay.
a mortgage company. We underwrite the most of our stuff in house. So it's my job to be able to take care of the client and just guide them through how to make a deal work.
Okay.
So our
that's
job
really
is to help guide them and advise them.
Awesome. Now, I think this will vary by the program, whether it's FHA or conventional or VA, right? So correct me if I'm wrong. VA, you could go 0% down, FHA 3.5%, and conventional will be 5, 10, or 20%, depending on.
Or 3%, potentially 3% for conventional.
Wow, 3% for conventional. Okay.
On first-time home buyer, for sure. And then also, if you're under a certain income limit, and there's a program called Home Ready, and you could do it with 3% down.
All right. Even if you're not listening, this is what I mean by people. You may be closer than you think. You're probably saving out 5, 10%, but even at 3%, this program is something you might want to go in and take a look at. Hence why I wanted to bring you on here, Joe, and mention these things that I may not have the full 360 picture of, but I do have the network that provides the net worth for this type of content. So thank you for sharing that. When people are running their own numbers, I mean, I always recommend speak with someone like you to see how far they are or how close they are to the process. But the debt to income ratio that I usually just calculate things in is 50%. What is the actual debt to income ratio, say for an FHA loan or for a conventional loan, that a potential buyer will have to be under?
That's a good question. So I'm going to talk about this in a couple different lanes. So you have front end ratio and back end ratio. Front end ratio is the mortgage as a percentage of your gross income. So you want that to be below 45%. From a back end ratio, meaning all other things on your credit report, car loans, student loans, personal loans, credit cards, all that stuff together. Still, you want to be under 45%, but
Yeah.
conventional will let you go to 50%. FHA will let you go to 56.99%. VA will let you go even. I've seen a deal get close to 71% back end. Now, that's
Wow.
kind of
Okay.
rare.
So front end is just the mortgage. Back
Mhm.
end is everything else that's on your credit report, credit cards, student loans,
Yeah.
and car loans.
The second part of that I think it's important to say is that credit scores do matter. But I hear people talking about, well, I got an 800 credit score. I should be able to do X, Y, Z. That's just like your seat to the table. Like credit score is just assumed to be able to play the game, right?
Yeah.
Has nothing to do with it. The most important piece of the puzzle, in my opinion, is income. But
Okay.
conventional, more sensitive to credit score. FHA, less sensitive to credit score. VA, also less sensitive to credit score.
I'm glad you worded it that way. Less sensitive. Okay. And then do that same one with the debt to income ratio. So FHA is less sensitive than.
Yeah, conventional. USDA, which is a rural product where you can buy a home with zero money down. USDA most sensitive to debt to income ratio. Conventional,
And that's
FHA.
45%.
For which one?
Oh yeah. So USDA is how much?
41, 43.
And that's just the front end or everything.
The front end has to be, I think, like the front end has to be like 32%. The back end like 41 or 43. It's very tight.
Okay.
I'm guessing on that, so don't quote me on it, but it's somewhere in
Okay.
that.
And conventional is 45%.
So back end conventional is 50%.
Back in conventional is 50%.
FHA is 56.99.
56.99.
Not 56, not 57.00, 56.99. Because I've seen it happen.
Yeah, and it has to be 0.99 because these are government programs.
Mm-hmm.
Okay. So as you mentioned, some are more sensitive to income, some are more sensitive to credit scores. I think that's very good information for people to be aware that, hey, even if you have high debt, there's still a program that may fit. Because 56.99, I mean, I think that's pretty reasonable. I think that's actually a lot of cushion
Yeah.
if you're looking for a mortgage, right? So for people that this takes me to my next question. Well, there's a lot of questions. Student loans. Student loans now, my understanding is if you're late right now this year, it's not going to impact your credit score. The balance though is reflected on your credit score because it just shows up like that. Um, there was a time where if you were in school, that student loan payment balance wouldn't take a hit towards your debt to income ratio. Now with this whole, I knew they weren't going to be forgiven, but
Yeah.
now that we have student loans back and payments are back, how is that impacting debt to income ratio? Is if someone says, "Oh, they're on furlough right now. I got like that 3-year furlough," or if I go back to school part time, how does that impact now, or how do you calculate it?
So the worst case scenario, FHA recently made a change, I think last year, where it used to be take the balance times it by 1%, and that's the
Okay.
payment we have to use for qualifying. So if
Okay.
you have $100,000 of student loan debt, which is not uncommon, that payment would be $1,000. That would
Yeah.
just automatically go in your ratio.
And a
Now it's
thousand.
a 0.5%, so half of that. So that's been a huge help.
Wow. So that changed when? Just last
Uh,
year?
yeah, so I think early 23, I do believe, and they also made another change too that lowered the um, PMI percentage in your payment, so that went to a lower number as well. It used to be 85 basis points, now it's 55 basis points. So that's a different conversation. Um,
Oh, yeah, yeah. See, it's new information to me.
mhm. Conventional, depending on if it's a Fannie Mae loan or Freddie Mac loan, it's between 1 or 0.5%. However, there are some other exceptions. One, you can use an income-based repayment schedule on unconventional. So if I go get an income-based repayment schedule payment, and it says $100, and otherwise the payment would have been $800, like we can use the lower amount in that scenario. Uh,
Okay. So let's get creative. That's one way to get creative, right? If you can go to that program and be like, yeah, we're going to lower your payment, and you can show the documentation, hey, this is the payment, then you will use that lower number to help their debt to income ratio and help their overall purchasing power.
Mm-hmm.
Now, what about some of these loans where there's like a parent that's a co-signer and the payment comes out of the parent's account? So then the student on paper is not responsible for the loan at all. Does that impact their debt to income ratio, or is that a way to get creative and you can recommend someone start doing that now so we can see that paperwork?
I'm not familiar enough with that scenario to comment confidently about it.
Yeah.
However, on the flip side of that, let's say you've got a parent who co-signed for a car or student loans, and now they're trying to go get a loan. If
Yeah.
you can document that somebody else is making the payment for 12 months out of their own account,
Yeah.
the co-signer, then you could potentially ignore that off of that person's
12
profile.
months.
Mm-hmm.
Okay. So that could be an example with the car payment as well, not necessarily a student loan.
Mm-hmm.
Would that be the same maybe with a credit card? So some parents add, if they're doing things right, in my opinion, are
Mm-hmm.
adding their child as an authorized user to the credit card,
Mm-hmm.
right? So let's say, again, things are getting tough, right? They have debt. So let's say this person applying for a new mortgage is an authorized user on that credit card. So that credit card shows up on their credit report and the monthly payment is $500. Just an example.
Mm-hmm.
But if they're an authorized user, would it be the same in that scenario where they can prove the owner of the account is paying from their own account and then that whole balance is just wiped out from their debt to income ratio, or the payment at least?
That it is possible. I would need to double check guidelines on the different programs to speak confidently about it. However, there's another thing that we've been doing recently that's been pretty successful, and it's just calling up the company and just taking yourself off as an authorized user. Which, once you do
Oh,
that, you can't.
yeah.
I can't monitor what you do after the fact.
Yeah.
So, and that's something that has been helpful. I had a couple married. Both were veterans, and they were going kind of one by one buying properties using their VA benefit with zero money down. Buy a property in one person's profile, and then when they bought the next one, buy it in the other person's profile. Kind of a way to be able to stack up properties and rentals over a period of time.
This is a
Both,
married couple.
yeah, married
Yeah,
couple.
yeah.
Both were
I've heard
actively.
that on the opposite end, for those filing bankruptcy. That way, like one's profile is all destroyed, and then the
Yeah,
other one is still like the life. But now
yeah,
you're saying people are getting creative like that to be able to stack up real estate faster.
yep. Because if you do it that way, then the next property that you're trying to purchase, that previous property isn't in their profile.
Yeah,
And that same scenario where I had somebody that I think had a massive 0% credit card. I forget the dollar amount. There was like a $400 payment, and they were trying to buy the second property in their name. So this would have been their third property. And so
overall.
taking the person off of the credit card was our solution, and it worked, and we got documentation on it, and that was the difference. So
Very nice. Now, so let's say the credit card balance puts someone over that debt to income ratio from 56.99% to
mhm,
60%.
mhm.
And again, a lot of this, there's deadlines to this, right? There might be a house that you want on the market, or, wow, that's a good deal. I got to get it. Um, is it still possible to just pay off the credit card and show the underwriting team, hey, this balance is now zero,
Yeah,
without waiting for the credit report to update 30 days down the line?
yeah, and I've got an example that happened recently on this that's I think pretty valuable from a couple different reasons. So that
Yeah.
scenario over on debt to income ratios, it was a couple, and one person had a score in the 680 range, which for FHA, 680 is kind of a tier that's top tier for credit scores and rates, whereas
Yeah.
conventional 740 is pretty much top tier. The co-borrower, the spouse, had a score in the 590 range. Something happened and their scores dropped, randomly. And so the solution was, okay, we got to help out the debt to income ratios. So pay down this one credit card. It was maxed out. And so paying it off helped us get under the credit score, under the debt to income ratio guidelines. Cool. But
Yeah.
also by paying off that balance, it was going to help that lower credit score person boost their scores. And so as a lender, I mean, we all have these tools available. If they don't have these tools available, then talk to somebody else. But we can do a credit simulation. Okay,
Credit
if you pay
simulation.
down this balance, 30% is typically the rule of thumb. Pay it down to this level. What's it going to do to your scores? And then we do a credit rescore, which we go to our credit bureau vendor. They will take the documentation showing it's paid the certain balance. They can fast track that process and get it back within 4, 5, 6, 7 days. And then we will re-pull a new report and it comes in higher. And so, yes, it helps the ratios, but 590 to 640 also has an impact on the rate structure and the rate cost. So it helped them also get a better cost structure for their interest rate, which helped them get to a lower payment. So it was a win-win, and we did that all under contract.
That's a great scenario that you bring up, which is, I think, the last question before we wrap up is, what's the lowest credit score you've seen someone get approved? I believe, correct me if I'm wrong, you have a 580, you can still get a mortgage loan. So for
Yeah.
people that are feeling like, oh, my credit's not that good, what's the lowest credit score? And two, does someone like you work with someone that repairs credit? Because for those that don't know, and correct me if I'm wrong, Joel, you can buy a good credit score.
I mean, like technically, there are platforms you can purchase other trade lines to put into your profile, which I don't know enough about the ins and outs of it, but I've seen it happen and heard it happen. But yeah, 580 is the minimum. There are programs that are out there that are more auxiliary that you can do it below a 580 score. Typically, those programs are going to require more money down.
Yeah.
But 580 is the minimum. I would say 620 is a level that, if you can do anything you can to get over 620, it's just going to have a lot of benefits of increasing the odds of approval and also with rates too.
Yeah.
There is one more
620 is what
scenario.
opens the doors more.
What's that?
So 620 would be what opens the doors more to
Yeah.
more programs and offers.
When you're talking about, okay, California, maybe relocate, different new job, work remotely, et cetera, to Nevada. I get excited about that because, I've got a client in a similar scenario. They live in Arizona, not as high of a cost as say California, but they're from St. Louis and they've been there and they're thinking about purchasing, real estate, and they want to be able to put together a portfolio. And, I don't mean any disrespect in saying this, but they were making, an average wage, right? And they couldn't afford a high dollar house in the area. And so they decided that they were going to move back home and they wanted to be very intentional building a portfolio. And so some of the things I put out there online on different platforms are because of a conversation with the client. And on Twitter or on X, I put together a scenario in Florissant, which is my hometown, North County, which I put together a 4-property scenario, put all the listings in there. I think the first purchase price was like 145, starter home, 2-bed, 1 bath, and then second one, third one, fourth one, and up to 550, I think. And did all the math on it, and then put together an Excel doc that shows the amortization, the equity buildup over 30 years, and it's a 2 million plus portfolio over 30 years, all by starting at the bottom. And that's the stuff that if somebody has that vision of trying to build a lane that they can build assets to maybe retire early, real estate, in my opinion, is a wealth multiplier. Like it's hard to live off of real estate income, especially at the beginning. But if you want to multiply wealth and build it from scratch, it's a tool.
Yeah.
Yep.
Well, it's been great knowledge that you've been sharing and wonderful insight. I'm sure there's many more questions that will come to mind after this conversation. So where can people follow you, Joel, if they want to take that first step and see how close they are to achieving the American dream? Which, again, I hope this first 55 minutes has gotten people thinking that they may be closer than they think, and there's ways to, quote unquote, bend the rules. So where can you find you?
If you Google Joel Farrell Stratford 25, you'll get to a platform, whether it's Instagram, TikTok, YouTube, X. You'll find me. Just message me. I'll answer.
Okay, and then let's use these last few minutes to promote you. You have a webinar coming up, or what's going on? What value are you
having? Yeah. Okay. So, and that's why I'm so passionate about talking about this stuff, because I came from nothing. I didn't know what I was doing, and built the portfolio. I didn't even know what I was doing, until 5 years in. I'm like, oh, this is actually working. And
Yeah.
then kept stacking, and then I was able to purchase a pretty expensive beach property in Florida, and I got there
Oh,
just by stacking over 15 years. And
very nice.
it was two. I bought it at $2.3 million. It's 5,000 square feet. It's a short-term rental, and it's done well.
For how much did you buy it for?
2.3.
And it's 5,000 square feet in Florida.
So sleeps like 25 as a
We're in
short-term rental,
Florida.
and so
Congratulations.
appreciate it, man. Destin, Florida.
Nice.
So
Nice.
white sand beaches, but
Of
so
course.
I do a lot of business down there as well, from the mortgage side. So we're going to be doing a live stream on the 15th, talking about cost segregation, which is a massive opportunity for high income earners that want to be able to minimize their tax liability. And real estate is a tool to be able to do that. People we know that are politicians don't pay taxes because of acquiring real estate and using this strategy. So we'll
Wow.
be
I need to
talking
get in
about
on
that.
that.
Yep.
So you'll be live streaming from Florida.
Yep. So
Wow.
that day, I've got a kind of a private event that I'm doing at a place called the Sowell House, doing some podcast interviews. I'm also going to be doing a panel with a few of the top agents in the area who are also real estate investors, and just talking shop and talking about the markets. And it's really interesting because in that area, there's two markets. You have, anything below $2 million is, struggling. And then you have the luxury market above 3 million, 4 million, 5 million. That's all cash buyers, stuff still moving. So it's just interesting.
Wow. Well, congratulations on that. I'm sure a lot of people that have tuned in and seen how wise you are and knowledgeable about the industry will want to get to know a little bit more about that. Because again, yes, in the first part we talked about 9 out of 10 times the answer is always increasing your income. But once you do increase your income, and once you do buy those assets with that income, once those assets cash flow you even more income, the next step is how to give Uncle Stan the least amount possible. And again, I think that's a lot of value. So thank you for sharing that. Again, anyone winners that tuned in, I hope you found a lot of information in this. If there's any other questions, please leave them in the comments below. Google Joel Farrell Stratford 25 and follow me there on X or YouTube or Instagram. I'm always providing great knowledge and information. And if you get a chance, tune into his webinar next week so you can protect your money and protect your assets and keep what's yours that you work so hard for. Joe, any last thoughts before we close this out? Thank you for your time today. I appreciate you.
No, building a community is just so important. Like being able to piggyback off of other people's wins and losses and learning, and just connecting with people in the comments and on Twitter and X, and just building relationships. That's just been such an important thing for me. So I'm just thankful to be able to be here and continue to meet cool people. So I really,
Oh, that gives me one more question
yeah,
that we get squeezed in here before the hour.
yeah.
So I do have my 9 to 5, and then now I do have additional streams of income through X and YouTube. How fast would or how soon can I start using that income as a means of approval?
That's a good
Do I
question.
need like 6 months for you to have an average, or
The safe answer is 2 years of tax returns.
2 years of tax returns is a safe answer?
Yeah. And
Okay.
that's a thing that's big right now, is people that started maybe a side business and using it to be able to shelter some losses.
Yeah.
If you're showing losses and have a lot of expenses with an LLC, like that's killed some deals for people that I started an LLC last year, and it's just showing
Okay.
losses.
I'm glad you brought that up, and that's why people need to tune into your webinar next week, because you're right. It could hurt you the opposite way if you're trying to get a mortgage and cover some of those taxes through some losses. So I
Yep.
guess that was a great question that we squeezed in there.
That's right.
Maybe you can provide way more insight next week. So again, everyone, Google Joe Farrell. Please like this video, leave a comment, help the algorithm, help people win out that are trying to get their new real estate property. Joel, thank you for tuning in. Stay winning, my friend.
Appreciate it.